Hello, my dear students. A very warm welcome to all of you in Shri Jayendra Rank Zone. I'm your friend and mentor for the subject Business and Commercial Knowledge. In this lecture, we'll begin with Business Chapter 5, that is Organizations Facilitating Business. All the concepts will be covered in the coming series of lectures. This is lecture number 1. Let us continue. Let us begin with the learning objectives first. After studying this chapter, you will be able to describe the meaning of business facilitation. You will be able to explain the need for organization and institutional arrangements for stimulating, supporting, and sustaining businesses. You will be able to differentiate between funding and non-funding organizations. You will be able to describe briefly the purpose, the functions, and the schemes of some of the facilitating organizations. Let's take the overview of the chapter. Organizations facilitating business in India. Funding institutions, we have NABARD. Non-funding institutions, we have RBI, that is Reserve Bank of India. We have SEBI, that is Securities Exchange Board of India. We have CCI, that is Competition Commission of India. Industry specific facilitation institutions, that is IRDAI. This is for insurance industry. Introduction. In the first chapter of the study mat, we have introduced business facilitators as a system of arrangements that ease the doing of business. Drawing an analogy, can you recall it? In our primary classes, we have read about our helpers, the way they simplify our lives and make us comfortable. Business facilitators do the same for the businesses. We rationalized their need in the context of complexities associated with pursuing business as an occupation. Career vis-a-vis well-defined employment and not so complex professional practice. One may argue that since auxiliaries to trade, aids to trade, such as banking, insurance, transport, warehousing, etc., to ease of doing the business, these should also be referred to as organization facilitating business. Yes, these are. All the auxiliaries to trade, helps to trade, aids to trade comprise an important layer of business facilitators. Let us situate these at an intermediate layer. In the layer above, one would like to place such policy making and executive agencies as Reserve Bank of India, the Securities and Exchange Board of India, Competition Commission of India (CCI), and such regulatory cum developmental agencies such as Insurance Regulatory and Development Authority of India. One may also envisage a layer of facilitators below that we may refer to at the point of contact layer. Together, these may be regarded as comprising what may be defined as business facilitation system. Point of contact business facilitators, auxiliaries, aids to trade, and funding and non-funding institutions. Point of contact POC, business facilitators helps the business in several ways. Consider the following illustrative examples. First, freight forwarder, that is a person or company who organizes shipment for the business firms to get goods from the manufacturer or producer to the market, customer, or final point of distribution. Note freight forwarder network with shipping companies airlines, railways and roadways, and origination, transit and destination ports, and warehouses, all auxiliaries oblique aids to trade to provide logistic support to the business. Next, a business incubator helps create and grow young business by providing them with necessary support and financial and technical services. And the business accelerator helps a budding business quickly launch a product and put it in the fast lane of commercial success. Business incubator. A financial consultant. A financial consultant who advises the business on the various sources of finance, domestic as well as foreign sources of finance, debt as well as equity sources of finance, short term as well as long term sources of finance, and helps it to mobilize its requirements too. It may be noted that the merchant bankers, the financial consultants, are not themselves the financing institutions, the auxiliaries to trade or the auxiliaries to trade. Next, a merchandiser. A merchandiser, a merchandiser who helps the business. Example, a fashion house obtains its supplies, fabrics, accessories. The term business facilitator is formally defined as in the financial sector as intermediary performing the host of functions, linking the banks, financial institutions, and their potential clients and their potential clients. Concept elaboration number 1, business facilitators in financial sectors. Government as a business facilitator. Business facilitators are intermediaries such as NGO, non-government organizations, farmers club, cooperatives, community-based organization, IT-enabled rural outlet of corporate entities, village knowledge center, agri clinics, agri business centers, Krishi Vigyan Kendra, and individuals like insurance agents, retired bank employee and teachers for providing facilitation service. Such services may include identification of borrowers, collection and primarily processing of loan application including verification of primary information, creating awareness about products, provide advice on managing money and debt counseling, processing and submission of applications to NABARD Financial Services Limited, promotion and nurturing self-help groups, joint liability group, producers group, post-sanction monitoring and hand-folding of self-help groups, joint liability groups, credit groups, producer group, etc. and follow-up for recovery. However, they shall not engage in cash handling, including disbursement, collection, etc. Business facilitators may be distinguished from business correspondents who may be defined as banks in person. These individuals and entities actually provide banking and financial services. Obviously, for this reason, business correspondents are more closely related than business facilitators who do not engage in banking and finance business in the sense of handling deposits, repayments, etc. Next, in the preceding chapter, we have seen how the government policy is a powerful and pervasive determinant of business activity. There is barely any sphere of business and commerce that is not affected by government policy. India's freedom fighter did not merely fight for political independence of India, they had a long-term vision of India economic development. The Union government came up with the Industrial Policy Statement in 1948, barely a few months after independence. In 1951, the Union government enacted the Industrial Development and Regulation Act. The IRDAI entrusted the government with responsibility of ushering in economic development via industrialization in India. The Industrial Policy Revolution in 1956 providing for the respective role of the public sector, large industries and small sector industries guided the growth of business in India for more than 3 decades. Initially, the public sector enterprise were to command the industrial development of India. Role of private sector was limited to the production of consumer goods. However, as the economy got stronger with time and other where wherewith all of facilitation of private businesses, example initially the development banks, industrial estates, and later a developed capital market took shape, the private sector has grown from strength to strength. In this context, a new economic policy of 1991, which is better known as LPG, liberalization, privatization, and globalization, that is, the policy of liberalization, privatization, and globalization is regarded as the watershed development in business facilitation in India. The government facilitates business not only via formulating business friendly policies but also by creating an institutional apparatus for the implementation of those policies. In the preceding chapter, you have learnt about the policies. In this chapter, we'll focus on institutions, the institutions who make policies. Non-funding institutions for business facilitation in India, Indian regulatory bodies. The institutions such as Reserve Bank of India, which is the central bank of the country, the Securities and Exchange Board of India, which is the apex body of securities exchange, and the Competition Commission of India, which is the rules setter for the fair play in business, provide the supra context of the business facilitation. Then there are industry specific businesses facilitator, two such as the Insurance Regulatory and Development Authority, Telecom Regulatory Authority of India, and the like. These institutions do not invest the business and as such are called non-funding institutions. In addition to the broad general descriptions of their roles and functions, our emphasis here would be on their respective roles as business facilitators. Here, it would be pertinent to mention that there are several other non-funding institutions that facilitate business right from the pre-formation to product and process testing, training of manpower, and host of business extension services. For example, the National Institute of Entrepreneurship and Small Business Development focuses on training and trainers in entrepreneurship development. Entrepreneurship Development Institute EDI is the national level apex organization of entrepreneurship development. Then there are 30 micro, small, and medium enterprises development institutes and 28 branch MSME DIs, formerly SISIs, set up in state capitals and other industrial cities all over the country to provide a host of services to the entrepreneurship, small businesses. These institutes render the consultancy services, prepare state industrial profiles, and conduct district level industrial potential surveys. Besides, these institutes prepare project profiles and facilitate quality control and upgradation in these enterprises. There are several commodity boards and export promotion councils that assist businesses in their international forays. Institutes like India Trade Promotion Organization in India brand Equity Foundation aims to enhance India's image as a sourcing partner and investment destination. We should not forget the facilitative role of government, such as schemes as Make in India, Startup India, for furthering facilitating Indian business. Reserve Bank of India (RBI). It's a central bank of India, country's central bank. RBI is also known as Bankers Bank. The Reserve Bank of India was established on 1st April 1935 in accordance with the provisions of Reserve Bank of India 1934 through originally privately owned. Since nationalization in 1949, the Reserve Bank is fully owned by the Government of India. The central office of the Reserve Bank was initially established in Calcutta but was permanently moved to Mumbai in 1937. The Reserve Bank affairs are governed by Central Board of Directors. The board is appointed by the Government of India in keeping with the RBI Act. Role of RBI. The Reserve Bank of India is the central bank of our country. It occupies a pivotal position in Indian economy. Its role is summarized as follows. The RBI is the apex monetary institution of the highest authority of India. Consequently, it plays an important role in strengthening, developing, and diversifying the country's economic financial structure. It is responsible for the maintenance of economic stability and assisting the growth of the economy. It is India's eminent public financial institutions, that is RBI, given the responsibility for controlling the country's monetary policy. It acts as an advisor to the government in its economic and financial policies, and it also represents the countries in the international economic forums. It also acts as a friend, as a philosopher and guide to the commercial banks. In fact, it is responsible for the development of an adequate and sound banking system in the country and for the growth of organized money and capital markets. India being an emerging economy, the RBI has to keep inflationary trends under control and to see that main priority sectors like agriculture, exports, and small scale industry get credit at cheap rates. It has also to protect the market for government securities and channelize credit in desired directions. Functions of Reserve Bank of India. The preamble of RBI, Reserve Bank of India, describe its basic functions. To regulate the issue of banknotes and keeping the reserves with a view to securing monetary stability in India and generally to operate the currency and credit system of the country to its advantage. I repeat, to regulate the issuing of banknotes and keeping the reserves with a view to securing monetary stability in India and generally to operate the currency and credit system of the country to its advantage. The Reserve Bank of India, being the central bank of India, performs all the central banking functions. These are issue of currency. The RBI is the sole authority for the issue of currency in India other than 1 rupee coins and notes and subsidiary coins, the magnitude of which has been relatively small. Next, banker to the government. Banker to the government. As a banker to the government, RBI performs the following functions. First, It transacts all the general banking business of the central and state government. It accepts money to account of these government and makes payment of their behalf and carries out the other banking operations such as exchange and remittances. It manages public debt and is responsible for the issue of new loans. For ensuring the success of the loan operation, it actively operates in the gilt edge market and advises the government on the quantum, timing, and the terms of new loans. It also sells the treasury bills, T bills, on behalf of the central government in order to wipe away excess liquidity in the economy. The RBI also make advances to the central and state government which are repayable within 90 days from the date of advances. Next, the RBI also acts as an advisor to the government, not only on policies concerning banking and financial matters, but also on a wider range of economic issues, including those in the field of planning and resource mobilization. It has a special responsibility in respect of financial policies, measuring concerning new loans, agricultural finance, legislation affecting banking and credit and international finances. Next is Bankers Bank. RBI acts like a bankers bank. The Reserve Bank of India being vested with extensive power to control and supervise commercial banking system under the Reserve Bank of India Act 1934 and the Banking Regulation Act 1949. All the scheduled banks are required to maintain a certain minimum cash reserves ratio, that is CRR, cash reserve ratio, with the Reserve Bank of India against their demand and time liabilities. Their position enables the RBI to control the credit position of the country. The RBI provides financial assistance to scheduled bank and state cooperative banks in the form of discounting of eligible bills and loans and advances against approved securities. The RBI also conducts inspection of the commercial banks and calls for returns and other necessary information from banks. Custodian of foreign exchange reserves. The RBI is required to maintain the external value of the rupee. For this purpose, its function as the custodian of nation's foreign exchange reserve, it has to ensure that normal short-term fluctuations in the trade-off not affect the exchange rate. The temporary things. When foreign exchange reserves are inadequate for meeting balances of payment problem, it borrows from the IMF, International Monetary Fund. India has taken loan from IMF, World Bank, and Asian Bank also. The RBI has the authority to enter into exchange transactions on its own account, and on account of the government, it also administers exchange control of the country and enforces the provisions of the Foreign Exchange Management Act, FEMA. The next function of RBI is controller of credit in the country. Credit plays an important role in the settlement of business transactions and affects the purchasing power of the people. The social and economic consequences of changes in the purchasing power are the serious. Therefore, it is necessary to control credit. Controlling credit operations of banks is generally considered to be the principal function of the central bank. The RBI is like any central bank possesses power to use almost all qualitative and quantitative methods of credit controls. Next is promotional functions. Apart from the traditional functions of central bank RBI, the RBI also performs the variety of developmental and promotional functions. It is responsible for the promoting banking habits among people and mobilizing saving from every corner of the country. It has also taken up the responsibility for extending the banking system territorially and functionally. Initially, it has also taken up the responsibility for the provision of finance for agriculture, trade, and small industries. But now, these functions have been handed over to NABARD, Exim Bank, and SIDBI. The Reserve Bank is responsible for overall credit and monetary policy of the economy. Next function of RBI, collection and publication of statistical data. It has also been entrusted with the task of collection and compilation of statistical information relating to banking and other financial sectors of the economy. Next is RBI's role in business facilitation. Currency policy. The RBI is responsible for the monetization of economy and in the recent context of demonetization or remonetization too. Adequate money supply is critical for the functioning of the economy. All the factor incomes in the modern economy are in fact money incomes. Business revenues too are monetized. Moreover, the RBI also oversees the viability of foreign currency to facilitate overseas business transaction. It plays an important built and indirect roles in the determinations of foreign exchange rates, that is the rate at which the domestic currency is exchanged with the foreign currencies and vice versa. So this was about the currency policy. The next is credit policy. The RBI does not fund the business or, for that matter, any activity. However, its policies have a major impact on the channelization of the banking resources for business generally, as well as especially for certain sectors. A small reduction in the SLR, statutory liquidity ratio, and CRR, cash reserve ratio, or bank rate can put huge funds and the disposal of the commercial bank for lending to the business and other sectors. Let us introduce ourselves to the measure of magnitude of financial parameters such as interest rate. It is also called the basis points. 1% is equivalent to 100 basis points. To illustrate, if current bank rate is 7.75% and the RBI decreases 0.25 basis point, then new rate will be 7.50, as 25 basis point will be equal to 0.25%. SLR and CRR are quantitative measures of credit policy. These affects funds availability to all the sectors. RBI has its armor qualitative measures of credit control, two through two through which it influences the credit availability in a particular sector. As an instance of sector specific impact of the RBI's credit policy, let us consider the provision of priority sector lending, that is PSL. Every bank is required to comply with the requirements by lending a specified percentage to its source resources of the industries and activities including the PSL. For example, loans to micro, small and medium enterprise MSME qualified as PSL. The policy of the RBI has tremendously benefited the MSME sector in India. Next, an inevitable part of the credit policy is the interest rate. The Reserve Bank of India influences the interest rate through such policy instruments as bank rate, since RBI provides loans to the bank either by direct lending or by rediscounting, buying back the bills of commercial banks and treasury bills, T bills. It is also known as the discount rate. Bank rate is the rate of interest at which the RBI lends to banks. It reflects the cost of the funds to the bank, who in turn adjust their lending rates accordingly. To illustrate, higher bank rate will translate the higher lending rate by the banks. The concept of bank rate is often compared with the repo rate and reverse repo rate. So it's quite simple. If RBI is the bank rate, the bank rate is 5% from RBI for the banks, for the commercial banks. Then these commercial banks will be lending to the customers at higher than 5%, that is 7%. This is bank rate. I believe you understood. Concept elaboration 2, bank rate and related concepts. First is repo rate, the rate at which the banks borrow money from the RBI against pledging or sale of government securities to RBI as known as repo rate. Repo rate is the short form of repurchase rate. Generally, these loans are for short duration up to 2 weeks. Repo rate differs from bank rate with respect to the time horizon. Repo rate is the short term measure and it refers to short term loans. On the other hand, bank rate is the long term measure and is governed by the long term monetary policy of the RBI. Next is reverse repo rate. It is the rate of interest offered by RBI when banks deposit their surplus funds with the RBI for short-term periods. Next is development of the financial system. Development of the financial system. Finance is said to be the lifeblood of the business, and a well-developed financial system is regarded as sine qua non, an absolute imperative for economic development. The financial system typically comprise financial institutions, financial instruments, and financial markets. RBI may be regarded as the heart of the financial system. It oversees the functioning of outreach of the commercial bank as well as non-banking financial companies. The funds that RBI usurp via stipulating SLR and CRR, cash reserve ratio and statutory liquidity ratio, are channelizing the development finance institutions called development banks in India. We shall be elaborating this in the section of development banks in this chapter. Next is fund transfer and payment mechanism. Making and receiving payment is an integral part of the economic transaction. In a modern economy, one may envisage paper-based and digital payments and fund transfer mechanism. Paper-based mechanism would include, for example, currency, checks, bills of exchange. Digital payments would include card swiping, internet banking, and so on. Reserve Bank of India provides over the system and sets the rule of the game. Can we imagine a thriving business sector without an efficient payments and fund transfer system? Securities Exchange Board of India, SEBI. The Securities Exchange Board of India was established by the Government of India on 1988 and given statutory powers in 1992. With SEBI Act, the 1992 being passed on the Parliament, the SEBI Act 1992 had come into force with effect from 30th January 1992. SEBI is an authority to regulate and develop the Indian capital market and protect the interest of investors in the capital market. Controller of capital issues has been repealed by the SEBI, an authority under the Capital Issue Control Act 1947. SEBI has its headquarters at a business district of Bandra Kurla Complex (BKC) in Mumbai and has southern, eastern, and western regional offices in New Delhi, Kolkata, Chennai, and Ahmedabad, respectively. Controller and Capital Issues (CCI) was the regulatory authority before SEBI came into existence. It derived authority from the Capital Issues Control Act 1947. In April 1988, the SEBI was constituted as the regular capital regulator of capital markets in India under the resolution of Government of India. The SEBI is managed by a board which consists of the following: a chairman who shall be appointed by the central government, and he shall be a person of integrity, ability, and standing in the field of securities market, law, finance, accountancy, economics, and administration, etc. Two members from among the officials of Ministry of Central Government dealing with finance and administration of the Companies Act 2013, who shall be nominated by the central government. One member from among the official of RBI, who shall be nominated by the Reserve Bank of India. Five other members, out of which three members shall be whole-time members, who shall be appointed by the central government and shall be person of ability, integrity, and standing in the field of securities market, law, finance, accountancy, economics, and administration, etc. Functions and responsibilities of SEBI. The preamble of Securities and Exchange Board of India describes the basic functions of the Securities and Exchange Board of India as to protect the interest of investors in the securities and to promote the development of and to regulate the securities market and for matters connected therewith or incidental thereto. SEBI has to be responsive to the needs of three groups which constitute the market: the issuer of the securities, the investor, the market intermediaries. These are the participants of the securities market. SEBI has three functions rolled into one body, which are as follows. First function, quasi-legislative function. SEBI draft regulation in its legislative capacity. Quasi-judicial, SEBI passes ruling and orders in its judicial capacity. And third, quasi-executive, SEBI conducts investigation and enforcement action in its executive functions. Though this makes it very powerful, there is an appeal process and create accountability. There is a Securities Appellate Tribunal, which is a three-member tribunal and is headed by Mr. Justice J.P. Devadhar, a former judge of the Bombay High Court. A second appeal lies directly to the Supreme Court. SEBI has taken a very proactive role in streamlining disclosure requirements to international standards. Powers of SEBI. For the discharge of its function efficiently, SEBI has been vested with the following powers. First, to approve bylaws of stock exchange. Second, to require the stock exchange to amend their bylaws. rules and regulations. Third, to inspect the books of accounts and call for periodical returns from recognized stock exchanges. Fourth, to inspect the books of accounts of a financial intermediaries. And fifth, to compel certain companies to list their shares in one or more stock exchanges. To approve bylaws, to amend bylaws, to inspect the books of accounts, to inspect the books of accounts of financial intermediary, and to compel certain companies to list their shares on one or more stock exchanges. Next, SEBI's role in business facilitation. SEBI is responsible for the development of India's capital market for the corporate issues of capital. For example, it facilitates public offering of capital by the company. Thus, these companies are able to access the capital market for their funding requirements. It also oversees the subsequent trading of their shares on the floor of the stock exchanges. It even facilitates overseas entities desirous of participating in Indian capital market and the domestic capital market entities desirous of participating in overseas market. SEBIs coordinate with the Market Developers and Regulators Board. It is responsible for investors' faith in the functioning of capital market and thus assures the corporates of steady flow of funds. Next is CCI, Competition Commission of India. Introduction. Competition is a contest between organism, animal, individual and groups, etc. In the context of business, competition is the best means to ensuring the common man has access to the broadest range of goods and services at the most competitive prices. The most competitive prices. With increased competition, producers will have the maximum incentive to innovate and specialize. This would result in reduced cost and wider choice of consumers. A fair competition in market is essential to achieve their objective. Competition Commission was set up to create and sustain fair competition in the economy that will provide a level playing field to the producers and make the markets work for the welfare of the consumers. Competition may be either direct or indirect as discussed below. Competition may be either direct or indirect. First is direct competition. What is that? Producers that perform the same function compete against each other. Example, fast food restaurant McDonald's and Burger King, Coca-Cola and Pepsi, Pizza Hut and Domino's have competition with each other. The next is indirect competition. Producers that are close substitute for one another compete. Example, a fine dining restaurant has competition with other local restaurants, but it also competes with nearby supermarkets that offer ready to eat meals such as frozen parathas and eat and serve dishes. There should be free and fair competition in the market to get the following benefits: encourage innovation, increase efficiency, and punishes the laggards. There should be three fair competition in the market to get following benefits: encourage innovation in the market, increase efficiency, and punishes the laggards. Boost choices that improve the quality and reduce the cost. Boost choice improves the quality and cost reduction. Ensure availability of goods in abundance with acceptable quality in affordable prices. Availability of goods in abundance of acceptable quality in affordable prices. The Competition Act 2002. Basically, competition law is a tool to implement and enforce competition policy and to and punish prevent and punish anti-competitive business practices by the firms and unnecessary government interference in the market. The Competition Act 2002, as amended by the Competition Amendment Act 2007, follows the philosophy of modern competition law. The anti prohibits the act prohibits anti-competitive agreements, abuse of dominant position by the enterprises, and regulates the combinations, that is acquisition, acquiring, control and mergers and acquisitions, which causes or likely to cause an appreciable adverse effect on the competition within India. Features of the Competition Act 2002. The Competition Act 2002 has been enacted to prevent the party practices having an appreciable adverse effect on competition, to promote and sustain competition in the market, and to protect the interest of investor, to ensure freedom of trade. With the enforcement of the Competition Act 2002 and MRTP Act 1969 shall stand repealed and the MRTP Commission shall be dissolved, the CCI came into existence, the Competition Commission of India, with the Competition Act 2002. The Competition Act 2002 provides an establishment of Competition Commission of India and prescribes its duties, functions and powers. The Competition Commission of India (CCI). The Competition Commission of India was established by the central government on 14th October 2003. The Commission is a body corporate which perpetual succession and a common seal. That means it has a separate legal entity. It's a body corporate. CCI consists of chairman and six members. So total seven chairman and six members appointed by the central government. It is the duty of the Commission to eliminate practices having adverse effect on competition, promote and sustain competition, protect the interest of consumers and ensure freedom of trade in the markets of India. The Commission is also required to give opinion on competition issues on reference received from a statutory authority established under the law and to undertake the competition advocacy, create public awareness, and impart training on the competition issues. Next, the Competition Commission has been establishment for the accomplishment of the following objectives. First, to prevent practices having adverse effect on competition, to promote and sustain competition in markets, to protect the interest of consumer and to ensure freedom of trade carried on by other participants in the market in India, prevent practices having adverse effect on competition, promote and sustain the competition, so promote and sustain competition in the market, to protect the interest of the consumers and ensure freedom of trade carried on by the other participants in the market. Next, role of CCI, role of Competition Commission of India. The preamble to the Competition Act states an act to provide keeping in view of the economic development of the country, for the establishments of commission to prevent practices having adverse effect on competition, to promote and sustain competition in markets, to protect the interest of consumers, and to ensure freedom of trade carried on by other participants in markets in India, and for matters connected therewith or incidental thereto. To achieve its objectives, the Competition Commission of India endeavours to do the following. First, to make the market work for the benefits and welfare of the consumers. Next, to ensure fair and healthy competition in economic activities in the country for faster and economic inclusive growth and development of economy. Next, to implement competition policies with an aim to effectuate the most economic utilization of economic resources, to develop and nurture to nurture effective relations and interactions with sectoral regulators, to ensure smooth alignment of sectoral regulatory laws in tandem with the competition laws. Next, effectively carry out competition advocacy and spread the information on benefit of competition among all stakeholders to establish and nurture competition culture in Indian economy. Next, the role of CCI as a business facilitator. The role of CCI as a business facilitator. Fair competition is a key to thriving business sector. CCI protects business from other businesses, UTPs, unfair trade practices, and penalizes the erring entities too. It promotes competition by preventing abuse of dominance by the market player and to deterrent of other competitors and consumers. As such, it ensures the coexistence of large and small enterprises. Next, Insurance Regulatory Development Authority of India, IRDAI. Insurance Regulatory Authority and Development Authority of India, IRDAI. Introduction. Insurance Regulatory and Development Authority of India is an autonomous apex statutory body which regulates and develops the insurance industry in India. It was constituted under the Insurance Regulatory and Development Authority Act 1999 and duly passed by the Parliament. The IRDA Act 1999, the IRDA Act 1999 allows the private players to enter into the insurance sectors in India besides a maximum foreign equity of 26% in the private insurance company having operations in India. The insurance bill proposed by the UPA government in July 2013 but passed in July 2014 raised the FDI limits to 49%. It serves as an authority to protect the interest of holders of insurance policies to regulate, promote and ensure orderly growth of the insurance industry and for matters connected therewith. The IRDAI roles is to protect the rights of the policyholders and they provide registration certification to the life insurance companies and responsible for renewals, modifications and cancellation and suspension of the registered certificates. Mission statement of the authority to protect the interest of the secure freight treatment of policyholders, to bring about speedy and orderly growth of the insurance industries, including annuity and superannuation payments for the benefit of the common man, and to provide long-term funds for accelerating growth of the economy, to set, promote and monitor and enforce high standards of integrity, financial soundness, fair dealing and competence of those it regulates. Next, to ensure speedy settlement of genuine claims, to prevent insurance frauds and other malpractices, and put in place effective grievance redressal machinery. To promote fairness, transparency, and orderly conduct of financial markets dealing with the insurance, and to build the reliable management information system to enforce high standards of financial soundness among the market players, to take action where such standards are inadequate or ineffectively enforced, to bring about the optimum amount of self regulation in day to day working of the industry consistent with the requirement of prudential regulations. Next, Section 14 of IRDAI Act 1999 lays down the duties, powers, and functions of IRDAI. Subject to the provisions of this Act and any other law of the time being in force, the authority shall have the duty to regulate, to promote, and to ensure the orderly growth of the insurance business and reinsurance business. The powers and functions of the authority shall include: first, issue to the applicants a certificate of registration, renew, modify, withdraw, and suspend or cancel such registration. Next, protection of interest of the policyholders in matters concerning assigning of policy, nomination by policyholders, insurable interest, settlement of insurance claim, surrender policy of value of policy, and other terms and conditions of the contracts of the insurance, specifying requisite qualifications, code of conduct, and practical training of the intermediary or insurance intermediaries and agents, specifying the code of conduct for surveyor and loss assessors, promoting efficiency in the conduct of insurance business, promoting efficiency in the conduct of insurance business, promoting and regulating the professional organizations connected with the insurance and reinsurance businesses, levying fees and other charges for carrying out for the purpose of the act, calling the information from undertaking the inspection and conducting inquiries and investigation, including audits of the insurer, intermediaries, insurance intermediary, and other organization connected to the insurance business. Control and regulation of the rates, advantages, terms, and conditions that may be offered by the insurer in respect of the general insurance business, specifying the form of manner in which the books of account shall be maintained and statement of account shall be rendered by insurers and other insurance intermediaries, regulating investment of funds by insurance companies, regulating maintenance of and margin of solvency. Next, adjudication of disputes between the insurer and intermediary or insurance intermediaries, adjudication of disputes, solving of disputes. Next, supervising the functioning of TERI advisory committee. Next, specifying the percentage of premium income of the insurer to finance schemes for promoting and regulating professional organizations referred to in clause F. Next, specifying the percentage of life insurance and general insurance business, life insurance and general insurance business, exercising such powers as may be prescribed. Next, The role of IRDAI as business facilitators. IRDAI also act as a business facilitator. Firstly, it takes steps to regulate and develop the insurance industry in the country. Secondly, it serves as an authority to protect the interest of insurance policy holders in create confidence among them. Thirdly, IRDAI disseminates a lot of information for the benefit of the policy holders and also for educating the general public about the advantages of getting insurance policies and keeping them alive. I believe you understood till here. I believe you understood till here. Let us continue. Funding institutions, Indian development market. Funding institutions, Indian development market. Development banks are those financial institutions that provide funds and financial assistance to new and upcoming business enterprises. Development banks are distinguishable from commercial banks. Unlike commercial banks, they do not accept deposits. They draw their revenues from government and other promoting agencies. As such, they are referred as the purveyors of credit. While discussing the role of RBI as a business facilitator, we mentioned that the instrument of SLR and CRR, the means through which the funds are usurped from the banking sector, and these funds are placed with the development banks. Know how SLR and CRR mechanism of statutory liquidity ratio SLR. It represents the ratio of liquid assets of the banks of their deposit liabilities. The liquid assets includes among other banks include other things government securities whose issuer is the Reserve Bank of India. Clearly, such a ratio is an indicator of banks liquidity and solvency, that is their ability to meet their liabilities on demand. Reserve Bank of India is authorized to stipulate the statutory liquidity ratio and thus mop up funds for the banking sector. These funds may then be made available to the development banks for purveying credits to the businesses. Next is CRR. It is the ratio of cash to total deposits that the banks are required to maintain on the daily basis. However, banks don't hold these as such cash themselves. They deposit such cash with Reserve Bank of India such as considered as equivalent to the holding cash with themselves. The amount raised by the RBI through prescription of the minimum ratio may also be utilized for channelizing by development banks. On 15 January 2020, the CRR, the current cash reserve ratio, stood at 4% of the current statutory liquidity ratio was 90%. Thus, RBI can usurp nearly a quarter of banks' funds for purveying credits in response to development needs of the country. It is possible. In India, In India, the genesis of the development banks may be traced to the setting up of the Industrial Finance Corporations of India (IFCI) in 1948. The setting up of the Industrial Credit and Investment Corporations of India (ICICI) took place in 1955 and the Industries Development Bank of India (IDBI) in 1964. The latter two development banks have since converted into commercial banks. Thus, the IFCI is the lone surviving Industrial Development Bank of India. The Small Industrial Development Bank of India (SIDBI) spun off from IDBI in 1990. The National Bank for Agriculture and Rural Development (NABARD) was set up in 1982. The National Bank for Agriculture and Rural Development (NABARD) is an apex development bank of India headquartered in Mumbai with branches all over India. The bank has been entrusted with the matters concerning the policy, planning and operations in the field of credit for agriculture and other economic activities in rural areas of India. NABARD is active in developing financial inclusion policy and the member of Alliance for Financial Inclusions. NABARD has been instrumental in grounding the rural, social, innovation and the social enterprises in the rural hinterlands. It has the process of partnered with 4,000 organizations in grounding many of the interventions. The organization had developed a huge amount of trust capital in the 3 decades of work with rural communities. NABARD is the most important institution in the country which looks after the development of cottage industry, small industry, village industry and other rural industries. Next, NABARD also reaches out to allied economies and supports and promotes integrated development. Next, NABARD discharges its duties by undertaking the following roles. First, to serve as an apex financing agencies for the institutions providing investment and production credit for promoting the various development activities in rural areas. So apex is financial agencies in rural areas. Next, take measures towards institution building for improving absorption capacity of the credit delivery system, including monitoring, formulating and rehabilitation schemes, restructuring of credit institution and training of personnel. Next, coordination coordinates the rural financing activities of all institutions engaged in developmental work at the field level and maintains liaison with Government of India, States Government, Reserve Bank of India and other national level institutions concerned with the policy formulation. Next, undertakes monitoring and evaluation of project refinanced by it. NABARD refinances the financial institutions which finances the rural sector. NABARD pre-takes in development of institutions which help the rural economy. NABARD also keeps a check on the clients of institutes. It regulates the institutions which provide financial help to the rural economy. It provides training facilities to the institutions working in the field of rural upliftment. It regulates the cooperative banks and the RRBs, regional rural banks, and manages the talent acquisition through IBPS CWE. NABARD refinances is available to state cooperative, agriculture and rural development banks, state cooperative banks SCBs and regional rural banks RRBs, commercial banks and other financial institutes approved by the Reserve Bank of India. While the ultimate beneficiaries of the investment credit can be individual, partnership concern, companies, state-owned corporations, cooperative societies, production credit is generally given to individuals. NABARD has its head office in Mumbai. NABARD is also known for its SHG bank linkage program, which encourages India's banks to lend to self-help groups, largely because self-help groups are composed mainly of poor women. This has evolved into many important Indian tools for microfinance. NABARD also has a portfolio of natural resource management programs involving diverse fields like watershed development, tribal development, and farm innovation through dedicated funds set up for the purposes. I believe you understood till here. I believe you understood. Let us quickly recap what we have done in today's class. Let us take a quick recap what we have done in today's class. So we have taken a chapter overview. We have taken the chapter overview. We understood about the non-funding institutions and the funding institutions. You have seen the introduction of the chapter. Business facilitation system, auxiliaries to trade, and the funding and non-funding institutions. Government acting like a business facilitator. Then we shifted to the non-funding institutions. We started with the Reserve Bank of India, the role of Reserve Bank of India and functions of Reserve Bank of India. The bank rate related concepts SLR and CRR, repo rate. We shifted to the Securities Exchange Board of India, SEBI, the functions of SEBI, the responsibilities of Securities Exchange Board of India, and powers governed by SEBI. SEBI rules in business facilitation. Then we shifted to the Competition Commission of India, CCI, the direct competition and indirect competitions, the Competition Commission Act 2002, the features of Competition Act 2002, the role of Competition Commission of India, the role of CCI as a business facilitator. At last, we have completed the IRDAI, that is Insurance Regulatory Development Authority of India, introduction and mission statement of the authority IRDAI, the duties, powers, and functions of IRDAI, the roles of IRDAI as a business facilitator, the funding institutions, that is Indian Development Banks, SLR and CRR mechanism we have seen in detail, NABARD. We are stopping here. We are stopping here. Thank you.